This past year we did $1.3 million in premiums. Today we are going to go over 7 downsides of the fixed indexed annuity. First is the surrender period and charges. These usually last between 7 to 12 years, sometimes a little bit shorter. They also can be longer depending on the company and product you go with. They usually are going to decrease over time though. So the first example, if you had a 10-year surrender charge, that means if you were to surrender the policy, try and cancel, take all of the money out, you would have a penalty of, after the first year, 10%, after the second year, 9%, and then you can see here trickles down until after the 10th year and on, you wouldn't have any penalty if you were to completely cancel the policy. Now, since these are going tax deferred, if you did cancel after the 10th year, of course, you would have to pay all the taxes on that, just like if you were to withdraw fully from a 401k after turning 59 and a half. Are you going to have penalties? No, but are you going to have to pay all the taxes? Yes. You do, however, have penalty-free access to a small portion, usually 7 to 10% a year. The plan should be, if you are getting a fixed index annuity or any type of annuity, not to touch this, but in case of emergencies, you do have that bit of flexibility there. Another thing to note though is, let's say you rolled money into an annuity at age 50 and 5 years in, you chose a 10-year surrender schedule, you wanted to access 10% of that money. Well, you would be able to do that without any penalties from the annuity company. However, if it was from an old 401k that was rolled over and the money's tax deferred, well, the same penalty rules still apply for that. So if you pull out of a 401k at age 55 before age 59 and a half, what happens? You pay a 10% penalty. Just because you rolled over into an annuity doesn't mean those penalties go away. You would still have the penalty from the IRS, just not from the annuity company. And then the main thing here to note is you'll see on your policy, an illustration, anything that's shown to you, you will see something called a surrender charge. And people will look at that and say, what is this surrender charge? I didn't know that I was paying this. Well, you only pay surrender charges when you surrender the policy. So that number just shows, hey, if you surrendered today, here's the charge you have to pay. It's not a charge that you paid or is being charged to you until you cancel. And if you get an annuity, hopefully the plan is not to do that. Second is they certainly can have limited growth potential. I think a good way to view these is as a CD or bond alternative if focused on growth solely. Can they certainly outperform these even over extended periods of time? Absolutely. But they do have cap rates, and then there's also participation rates, which are the percentage of the return that you would get. So in this example, if it was the S&P 500 with an 8% cap, and let's say it was a 100% participation rate, which means you get 100% of whatever it is, and the markets went up 10%, or the S&P went up 10%, well then you would get only up to your cap, 8%. The good news is, if the S&P 500 goes down 10%, 20%, 40%, well, you're protected from that, you wouldn't lose, so you would get 0%. You don't gain anything, but you didn't lose anything, and these caps can rise with interest rates or lower, especially when interest rates are down. They can definitely have limited growth potential. Next here, and this isn't really a negative, you just need to take the time to educate yourself, but they certainly can be difficult to understand. So in terms of terminology, we went over there, some of them, cap rates, par rates, and then the tax treatment can certainly be confusing. Now, for most people, they're putting money in and rolling over from 401ks or IRAs, money that's already tax deferred and they've never paid taxes on it, is going to keep growing like that. And no matter how they take money, it's going to be fully taxable. For some people though, if you're putting in money that's post-tax dollars, that's where the tax treatment can get a little confusing. Now, surrender schedules, we went over MVAs, market value adjustments, spreads, bonuses, riders. These are all things that have different effects on your policy if you have them or if they are on your indexes or not. Most policies only have some, but the main thing is whichever ones that your policy has, you definitely want to make sure you understand them. None of these things are complicated. It's just a lot of terminology that's very specific to the annuity industry. So you need to make sure that your agent is helping you understand those things and there's no confusions. And then along with some of these can come fees, for example, certain riders. And if that's the case, you need to make sure you understand those. Now, there's also no fee products. So if you are someone who's worried about high fees, there are options without any, but you just need to make sure whatever you're doing, you understand what are the fees, where are they coming from, and how much are they gonna cost me. The last 4 downsides here we'll go through pretty quickly, but first is that an insurance company could technically go under. Just like banks can go under in the Great Depression, 9,000. In 2008, 400 banks went under, more on the watch list. Insurance companies could technically fail. Now, it's important to note that insurance companies are not legally even allowed to be as risky as banks. Banks have loan-to-value ratios there at 80%, some higher. Insurance companies much more like 50%, and there's a reason that a lot of banks keep their liquid cash in cash value life insurance in insurance companies and not in other banks. Why? Because they view them as much safer institutions. Is there FDIC? No, there's not, meaning if the insurance company goes under, the government isn't guaranteed to bail out a certain amount. However, these insurance companies are generally cross-insuring, and if one were to go under, like AIG in 2008, well, what's going to happen? Another insurance company, usually, since they make their money just from holding money and investing it somewhere else and earning a higher rate of return, usually an insurance company will swoop up all of that business, and now they just got a whole bunch of real loyal clients, and they have a whole bunch more money to go and invest in loans, government bonds, bills, whatever. But technically this is a downside, so I wanted to include it. Next is these are not short-term solutions. As you saw, there's those surrender schedule and surrender periods. They are great CD and bond alternatives, but they're not alternatives to a 1 or a 2-year CD, and then it's money that you're gonna go and put a down payment on a house on. These are longer-term vehicles, ones that you're usually planning to eventually at some point take income after. Sometimes it can just be for growth, and maybe you'll take withdrawals or surrender after the surrender schedule is over. But the main thing is, if you're gonna put money in here 2, 3, 4 years in, try and withdraw all of it, you can do that. The money might have grown, but you're gonna have to pay taxes on that. You're gonna have to pay the surrender charge. It's just not worth it. You need to keep this in mind when you're initially looking into annuities and make sure they're in your best interest. Another one here, this is a fake concern, but commissions are high. That's why I put it in quotes there, is a lot of people think, well, if an agent is getting 6 or 7% of the money I put in, that's ridiculous. That's a lot of money off the top. I want to note here, let's say someone put, just to keep it at an even number, $100,000 in here. If the agent gets a commission of 7% of $7,000, that does not mean that you get only $93,000 to go into your strategy. Actually, you still get the full $100,000. Well, how is that? That's because agents are paid by the insurance companies for bringing them your business. This money is not coming from you, it's coming from the insurance company. It's part of their overhead. When you put in $100,000, they're gonna take this money, they're gonna go out, they're gonna invest it, they're gonna earn a rate of return, say 5, maybe they'll credit you 4 in options, and that 1% spread that they have there, that is what's going towards commissions, their staffing, their overhead. The rest of it's left for profit. These businesses, insurance companies, banks, are very small margin businesses. That is how they stay afloat. And also, the surrender schedule and period is there for a reason, because if you surrender, they want to make sure they still had money there that they could have paid the agent and they're not at a loss. So that's another reason that's there, is because if you don't surrender, they know that they had enough time to make a high enough rate of return to where they could have afforded that commission and then still profited on top. So it's not coming from you, it comes from the insurance company. And even if it did come from you, 7% one time upfront versus 1% recurring as a financial advisor fee into perpetuity, it's actually going to be a lot less over time. Last thing here is the lack of liquidity. So we said there's that 7 to 10% liquidity that you're gonna have access to each year. However, if it's more than that, if a real big emergency came up and you did need that money, you would have to take some surrender charges. Again, this should be something that you are planning to put money in, maybe let it grow a little bit, and then turn on a lifetime income stream guaranteed, no matter what, that's gonna pay out to you and you can be at peace. That's the main thing with these annuities. We're not necessarily trying to hit home runs, trying to optimize for the highest possible rate of return, but it's really about getting your money there, having it sorted, guaranteed, no risk, no money in the stock market. Instead, you have that guarantee, the peace of mind, the money's gonna be there, and you don't have to worry about finances. You can focus on what matters most to you. If you'd like to learn a little bit more about how these might play in with your own personal situation, book a 20-minute quick consult with myself down below. I'd be happy to take a look.